Thank you so much, Andy. And how can you hear me up the back? Is that okay? Yeah. Closer to the mouth. Hello, everyone. Brynn from ACCR. Huge thanks to our partners in this event, as you saw, AIFA, Carbon Tracker. It's really an honour and a privilege to be in this room with you all today to discuss a really important topic, and I'm super excited about our panel. Before I start, well, I'd like to start with an Australian custom, which is to acknowledge the First Nations people, the traditional custodians of the land on which we meet, which is the Lenape people, who called what is now known as Manhattan Mannahatta. I want to pay my respects to their elders, past and present, and to acknowledge First Nations people in the room. I think it's a particularly important thing when we're talking about stewardship to recognise the leadership and the stewardship of First Nations communities around the world, communities upon whose land so much of the activity that we're here to discuss today occurs around oil and gas extractivism and for that matter, the mining of transition minerals and coal and all of our natural resources. I will introduce the panellists. I'm going to try to be an active and conversational moderator today. We were having some great chats in the breakout room, so I hope we can bring some of that energy in front of the audience today. So I'm joined by Karina Litvack, who is currently a non-executive director at Terna, former director of Italian oil and gas company Eni. And Eni is a really fascinating company that I'm hoping Karina can also share some of her stories, maybe boardroom stories, war stories from working with that company. But certainly a company that is transitioning, an oil and gas company that is transitioning. Karina is also the founder of Chapter Zero, which I will try to explain. It's a global network for company directors who are motivated to solve the climate crisis. So really excited to have you today, Karina. We also have Eivind Fliflet, who is from Norges Bank Investment Management, the Norwegian sovereign wealth fund. I think you guys are at about $1.4 trillion US, roughly, right? And one of the biggest owners of equities in the world. So I think roughly 1.5% of most companies in most markets. You can correct me and when it gets to you if you need. And then we have John Hoeppner, who is from Legal & General America and is the head of US Stewardship and Sustainable Investments. Really excited to have you on the panel, John, to speak to the way that LGIM's strategy is evolving in relation to engagement with companies. So we're here to talk today about engagement. Engagement is a topic close to my heart. It's what ACCR does all the time. So ACCR has a portfolio of shares in the Australian market, the Japanese market, and on the London Exchange. They're all heavy emitters, and we use the rights that shareholders have to try to decarbonise them. Engagement is a really contested space. I think really rightly, there's a lot of questions being asked about its potential and its effectiveness, and I think it's really on us, engagement practitioners, in this moment of urgency to hold ourselves accountable for the results of those engagements. And I'm looking forward to unpacking some of those really quite challenging topics. I think there are a lot of good questions being asked of us by the community of people who care about climate change and recognise that we're really dealing with a dwindling carbon budget now. So with that framing, I'm just going to throw around to each of the panellists for a short introduction to their work, and I'll start with Eivind. NBIM released, I think, just last Friday, some updated expectations of companies on climate change. I would love for you to walk us through maybe what that means for your engagements.
Absolutely. Thanks for having me here. And I guess we've all seen the summer that we've experienced for the good and bad, and really illustrating that climate change is becoming more and more a financial material topic for markets and for companies. And so we're at a time when many other assets managers are taking a step back, we recognize the need to stay the course and to also increase our work on this topic. So we've published updated expectations on climate change, which apply to all the companies, 9,000 of them in our portfolio. And we highlight 6 core expectations that are foundational to our board level dialogue and that inform our voting decisions. So I think it's stuff that you're all quite familiar with, shouldn't come as a surprise: board oversight, greenhouse gas emissions reporting, climate risk disclosures. But I think the highlight there is the focus on transition plans, which for us is a quite narrow concept. It's about the plan of how you're going to actually reach your targets. So we want to see credible investment and business plans to reach interim emissions targets. So really asking for what are the levers for your company to reach your 2030 targets, how much of decarbonization is each of those levers going to contribute, and how much money are you putting behind each of these levers? So give us some meat to the bone of your targets. And we're increasingly going to use these core expectations to vote against the re-election of board members that do not fulfill these expectations, and when we're filing our own shareholder proposals as well. And we'll particularly focus on companies that don't have sufficient short and medium-term targets or meet minimum reporting requirements, such as just telling us their greenhouse gas emissions or having board oversight. I think I'll just finish. We also published a detailed view on companies' use of voluntary carbon credits. Hugely complex topic. We landed on saying that we don't want them to be part of your strategy to meet interim reduction targets, but you can use them to signal high climate ambitions. And we really see the need for these in the long run. If you're going to reach net zero, you need to net somehow. And we don't want to say to companies that are using them now to stop buying them. We just don't want them to be confused with the company's own actions and the priorities that they're taking to reduce their own emissions, and to confuse investors about what's actually going on inside of the business. So we're asking for more transparency on that, and proposing that companies also tell us how much they've offset, what price they paid to help the market evolve, and encouraging companies that will need to rely on removals offsets in the long run to start building that portfolio now. Because once you get to 2050, you can't just assume that there's going to be a huge market for carbon removals projects that you can access just like that to reach your net zero targets. You're going to have to start thinking about that beforehand. Let me pause there and give it back to you.
So there's a lot to cover there, and I won't disrupt the flow yet by going into what some of those commitments mean. But Karina, I'd love for you to maybe tell us a bit about Annie's journey and the role, if any role, that shareholders had in engaging with the board to push the transition along.
Okay, it's this honor to Oh, now, okay. So the first thing is that the investors put me there. So the investors decided in 2014, and I should say it has always been routine for 25 years in Italy for investors to nominate up to 1/3 of board directors. So it was nothing Exxon-like, if you like. It was an entirely normal and routine process by which the institutional investor community, Italian and international, come together every year, and they nominate 1/3 of directors, because directors are nominated for 3-year cycles. So I was one, and I was the first non-Italian. Of course, you have to speak Italian, so they had to settle for me, because there aren't that many people who aren't Italian. And they wanted somebody who would bring a sensibility on governance, sustainability, climate, and also international investor expectations. So that was the brief. And obviously my legal responsibilities were identical to those of other directors. But I landed there and discovered not only that as a board, we didn't have the skills, and this is not intended as any kind of vicious critique or anything. I discovered that it was entirely standard that directors do not get picked because of their climate competence. It's just not the norm. And moreover, I personally realized that what I knew from by then 20 years of being in the investor community and having, focused both on the oil and gas sector and on climate change, that it's one thing to be the investor, to be the Eivind. It's a very different thing to be on the other side and to actually action this. And so that's why I got to work creating what has become Chapter Zero. It's called Chapter Zero in a number of countries. We're in 71 countries now, but the mothership is called the Climate Governance Initiative. It's an initiative that we launched in partnership with the World Economic Forum, and essentially it's about mobilizing non-executive board directors. We now are around 100,000 directors in the world, in all continents, to say, we as individual directors, in a personal capacity, we don't speak for our boards because we're not the CEO or the chairman, pledge to be that voice that is advocating for the adoption of a 1.5 degree aligned climate transition strategy. And with that come all of the things that you just heard Eivind say, and frankly, a lot more. And it's not, again, it's not a criticism by any means. It's just that we've laid out if you like, a curriculum or a checklist or, of things that if you're a good board director and you understand what it means to have a robust Paris-aligned climate transition strategy, you have to have thought of all of these things. You have to have thought about what the audit committee does, audit and risk, what, remuneration, all of the things that a good board director is supposed to do has to have a climate lens incorporated into what we do.
And can you then tell us about what that looked like for any?
Yeah, sure.
For an oil and gas company, and this is real.
Absolutely. So I arrived and I did a word search in all of our publications for climate transition strategy, and I found nothing. What I found was flaring down and reducing our scope 1 emissions and reducing water consumption. Basically, your old-fashioned ISO 14001 good practice. There was nothing about reimagining the business model for a world that is zero carbon, zero. So I sat down with the CEO, I was 3 weeks in, to say, so I can't find any evidence of our climate transition strategy. What is it? And the answer I got was, well, what do you think it should be? And that's what began a conversation that led to him saying, well, clearly we have to get out of oil. It's not going to happen overnight, but we have to chart a path that is going to take us out of oil first and then out of gas. And in our case, it's not about switching off the lights. It's not about, managing ourselves to extinction. It's about replacing it with the provision of clean energy. But of course, that's not for everyone. So in the case of Eni, that was the choice that was made. And so the company, it took us 6 years to craft what is, in my view, a very comprehensive and ambitious transformation strategy. In that 6th year, it was announced that we were going to be scopes 1, 2, and 3 minus 80% by 2050, which I said was good, but not good enough. And then in the 7th year, we got it down to 100%. So by 2050, 100% of our emissions would be eliminated through technologies that we have already tested, costed, invested in, so that we weren't saying, as some companies will say, oh yes, we're going to be net zero by 2050. Of course, it'll depend on new technologies coming on stream. Of course, it will depend on our customers taking ownership of this and taking their responsibility. No, in our cases, we are providing energy to our customers in the same way that you switch on your phone and you don't ask yourself what's in there, you just know it works. We are providing to our customers energy that is zero carbon over time. So by 2040, our electricity provision business will be zero by 2040. By 2030, the upstream business will be scopes 1 and 2 zero, but not scope 3. By 2050, it'll be scope 3 zero. So and what that means is that you have to cut production. There's no other way around that. Right? You're not going to do it by flaring down. You're not going to be doing it by capturing fugitive methane emissions. The only way you do it is by taking oil and gas out of production. And that's the bullet we all have to bite in the oil and gas sector.
So thank you for naming it so clearly. And I really And I think this is a real challenge because as shareholders, now we're having this conversation about, well, this is what needs to happen. Production needs to decline, or parts of certain businesses need to die, and some certain businesses need to not be businesses anymore. But how do we use shareholder tools to achieve those outcomes? How can we be effective against that? So with that, I might throw over to you, John, to just walk us through LGIM's approach. I know you guys have a pretty comprehensive strategy, and the audience would love to hear more about it.
Sure. Thank you, Brynn, and thank you, hosts. I'm always a touch skeptical when talking about engagement in the US, and there's a panel of all non-US members, but I think that's kind of symbolic. And so I'm putting my LGIM America's hat on, but I'm, as Brynn mentioned, I'm part of LGIM 22-person investment stewardship team, and asked, how do we approach stewardship? So first, before I get into kind of the details, it is really corny, but it does start with, as a big asset manager, you say, who are you as an asset manager, and make sure that purpose is really, really clear. So our purpose as an asset manager is to create a better future through responsible investment, which sounds a bit vague. So you go a little deeper. And for my team, the investment stewardship team, we have a really clear kind of North Star. And that North Star for us is to protect our clients' assets by raising the minimum standards and driving best practices for the incredibly diversified portfolio we hold. So we know as our strategy, we have a highly diversified portfolio. Consider us as passive investors, index investors, we're permanent holders. So we genuinely feel a fiduciary, a stewardship obligation to be protecting our entire portfolio for the ultra long term. So that's really, really important as we design our strategy. So number one, how does the strategy work? We start with being incredibly transparent. So that's transparent with as prescriptive as we can be with every policy that we're taking that has implications on our portfolio holdings. That means for every name that we hold, to the roughly the 13,000 public securities, we have our own house view of kind of an ESG score. And if you look specifically at our view of their climate risk assessment, we have a climate risk assessment for all the companies we hold publicly. We'll get into some of the actions. So then we're very willing to use the full breadth of stewardship actions. That starts, of course, with direct one-on-one company engagement, collaborative engagement, very willing to join collaborations, even though, particularly in the US, many of our peers are viewing this through a lens of anti-competitiveness. We're not particularly concerned. I mean, you have to be careful, but we're willing to continue to use that. We are very willing to vote with shareholder proposals. So I think the stat from a US perspective, in the last proxy season year to date, if we isolate just environmental and social proposals, we voted in support of 70% of US E and S shareholder proposals. We can get into what that looks like if we just isolate climate resolutions and how that looks. And then I think what we're referencing in some of our prep talks is right up front, we designed something called, for us, is our flagship climate engagement program called the Climate Impact Pledge, where we have a structured engagement. So engage with companies in two different ways. One is a hyper-targeted deep engagement where we actually are reading all their sustainability reports. We create our own assessment. Think of it as the TCFD, our flavor of the TCFD, using trying to understand mapping their data to kind of that framework and understanding where there are gaps. But there's also a light touch version of this where we're essentially scraping through all the public documents, not ourselves and not in a deep dive conversation, but in each of those, notifying the company time-bound expectations with escalation to a director vote. So that program's been in place for 7 years now. We've voted against many directors, and we've, in targeted portfolios, divested from companies that have not raised. So the question, which is just, I'll just preempt it, which is, how do you do that in a fiduciary context? How do you do that in a, having US clients? It is, you kind of find this, for us, the balance is you can vote against directors in all funds with where you have discretionary vote, and then you divest from companies that are laggards in sustainability branded funds. So that's our balance. Of course, it's imperfect, but we feel like it's kind of matches what our public statement is and is as consistent as we can be.
Thanks, John. And to highlight, LGIM is one of ACCR's collaborators. We collaborated together on an escalation with Glencore over the last sort of 12 months. And we took that to a shareholder vote, and we also campaigned on the company's climate action plans plan, we got, I think, 29% on our shareholder resolution, which not enough, but, giving Glencore's register is a pretty solid result, and 30% against the climate plan. But what I want to point out is that over the course of that engagement, our collaborators and a bunch of other institutional investors were putting pressure on Glencore about their greenfields coal expansion. And over that time, Glencore made the decision not to pursue the huge greenfields Valeria coal mine in Queensland, which means that over a gigaton of emissions won't go into the atmosphere. So when we're looking at our impact and we're looking at real world emissions, that's the kind of work we're looking for. And while, it's impossible to attribute that decision to any one engagement, we're really glad that we were at the table with LGIM doing that work together. So I wanted to just ask you one more question, John, about when you say you're looking at protecting your portfolio for the ultra long term, what does that mean?
So, I have to be careful where you're going with this, but, we think of ourselves as permanent capital, right? So I know there was some discussions, some earlier conversation or earlier panels around market cap indices and just how do you play off the tension between market cap indices and potential transitions that have to happen. I wouldn't say we are so profound that we have cracked that incalculable puzzle, right? So you bring, as an asset manager, you bring the latest indexes to the market. You think you have a smarter way of thinking about it. I can't say that we've unlocked this idea of how you can do ultra long term in the current context. But for us, I don't have a time frame of what that means, but it's permanent capital.
But I guess the point I'm kind of alluding to is that you do have a system stewardship approach. So you consider the risk of runaway climate change on the entire financial system and the economies and social systems in which you invest when you're considering when you're undertaking your engagements with companies. That's relevant. Yeah,
absolutely. We've gotten comfortable with the broader concept that a systematic risk is going to impact your underlying investors, so you have to focus on it. Climate's obviously a wonderful case, but beyond just even climate, there are all sorts of topics. Eivind mentioned how they structure their priorities. For us, if I take one quick step back, we have 6 mega themes that we're targeting. I can send you a link on it in the future, but the general idea is each individual company we engage with, very often when I'm talking with a company, they'll say this, we've done our materiality matrix, climate doesn't impact us, deforestation doesn't impact us. It must not be a risk. And we've gotten over that by saying, look, we are fundamentally believe this is a risk to our investors. So it's important for us to understand your disclosure, et cetera.
Eivind, I was kind of on the same theme. Like, how does NBIM approach these really macro questions, these really long-term investment questions, given that you're investing on behalf of a people?
Yeah, and I think that's makes our job easier and harder. I mean, because we have one owner, which is the Ministry of Finance, which is then gives us a mandate, which is anchored in, or is also decided by Parliament, which is then obviously representing then the people who own this money. And we manage it on their behalf according to this mandate. So there was a government commission a couple of years ago looking into climate risk and the fund, and they found out, no surprise, that the fund would benefit from a climate transition in line with the goals of the Paris Agreement. Runaway climate change and would not be in our financial interest. So we got a new mandate saying that we should integrate it into our responsible investment practices, the long-term goal that companies align their business activities with the goals of the Paris Agreement. On the back of that, we make a goal that all our companies should be net zero. Right? They should set net zero targets and work towards that. So I think we have a systems perspective as a motivation for our work, but it doesn't necessarily motivate the companies we speak to that we would benefit from that. So we always take a financial materiality lens for the companies when we speak with them, when we develop our expectations, when we vote, because that's essentially what the companies can impact. And the way I look at it is, if you cut too much emissions too fast, it's going to be unprofitable. If you cut too little emissions too slow, it's also going to be, you're not going to manage climate risks in the best way. So there's an uncertainty band there. And companies have to find out and navigate that uncertain demand and figure out where they would need to land for their business. They know their business better than us. But given our system's perspective, it's in our interest if they just err on the side of cutting a little too much rather than cutting too little, a bit too little. So it's difficult to sort of integrate that into dialogues and measure that in any way, but that's sort of how I think about the motivation for our work, at least.
That I'd like to maybe slightly challenge the idea that companies always know best. This will be where it gets spicy. So ACCR has done some modelling recently on the biggest Australian oil and gas company called Woodside, and what we have found from a fundamental value perspective is that there is a pathway for them that is value accretive with no emissions growth and lower risk, and that is that they just stop investing in the growth portfolio that they've set out and they return that capital to shareholders. Now, their current strategy is growth, growth, growth. That's what they plan to do. It's totally misaligned with a safe climate. How would NBIM view those kind of strategies? This is a nice hypothetical because I know NBIM does not hold Woodside because it's pure play, but is that something that's on the table for you when you're looking at companies in your portfolio?
Yeah, it's always nice to have hypothetical questions, but if a company tells us that we can make you more money by shutting down our business, then that's great. Yeah, as long as that's done in a way that takes into all
Disorderly, yeah.
Yeah, it's not disorderly, and that's perfectly fine.
So I'll just give a plug. There are some postcards around the room with the QR code for that report on it, and we would love for you guys to scan it and read it. But yeah, please.
I have a question for you that is not hypothetical, if I may, but I'm not going to name
This
names.
is when the moderator starts to sweat.
No. You have companies in your portfolio that are not pure plays. I'm thinking of one in particular. It's an oil major that passes the test because it is investing heavily in renewables. However, it has also very explicitly stated that it is not going to limit its growth in fossil fuels. It is going to grow as much as it can, particularly in gas, because why not? It's profitable, and as long as it's profitable, as long as there's demand, it does not subscribe to those those precepts that are being issued by the International Energy Agency, IPCC, and so forth. So, then what? I'll tell you.
So in our new expectations that came out on Friday, we are to backtrack. I mean, there's a huge discussion: what drives change? Is it constraining supply or constraining demand? What we're saying is that companies should set scope 3 emissions targets for aiming for net zero, right? So I think that tells you something about the business model shift that needs to happen. Then we're also saying that for companies with fossil fuel demand, they should consider expected demand change and climate science. Mm-hmm. What does that mean? Well, that's opening up a discussion with the companies, because what is expected demand going to be, right? I think that is, at least there's going to be a very different perspectives on that. But just telling the companies, at least tell us what demand you're expecting, tell us the assumptions, and tell us how you think this is aligned with climate science, is sort of putting the onus on them to explain to us their business strategy.
So Karina, to throw it back to you. So say you're the director of this company that is pursuing renewables investment and also pursuing emissions growth. What kind of strategies do you think would be effective coming from, say, John? in what's going to effectively, what's going to actually make you as a company director change?
Okay. So you've alluded to it by saying we would invite the company to explain to us their reasoning, and their reasoning can only be grounded in a view that demand will continue to grow. Whereas in Eni, we took the view that demand was going to peak, was going to peak in oil sometime in the first half of the 2030s, and it was going to peak in gas sometime in the second half of the 2030s. And therefore, it made every sense economically, strategically, for the company to bet on that dip in demand. It also said that even if it doesn't, we are scientists. The CEO is a physicist, a substantial proportion of the staff are scientifically trained, and we accept the science, so that even if others disbelieve those projections, such as what recently came out by the IEA about demand peaking, and obviously there's a huge amount of debate about that, we subscribe to that view. This company does not, and nor do the Americans. And so what I would do as a director, or what I would do as an investor, is to challenge their assessment of demand, because it is a judgment call. And if you get it wrong, I mean, are you stress testing your model? In other words, as we did in at my urging, because I chaired the Sustainability and Scenarios Committee, and I said from day one, are we stress testing our model against a 1.5 degree scenario? Because as of 2014, we did not believe that a 1.5 degree scenario would happen. And then as we moved forward in time, we took the view that if it didn't, it should, and therefore we should be resilient in the face of a 1.5 degree scenario. So now, Eni routinely stress tests its portfolio against a 1.5 degree scenario, including by when it does its annual impairment review. It checks the headroom that is available, but in other words, the difference between book value and present value of future cash flows. And in the event that headroom goes into the red in a 1.5 degree scenario, it has a commitment to adjust that so that it is resilient in a 1.5 degree world. And that's what I think investors should be demanding.
Yeah, and so you want to jump in,
Yeah,
John?
let me jump in on that. So what you didn't say was vote against the director
Yeah.
or vote shares. Sell portion of your book. So let me kind of loop back because, and this goes to some of our prep calls, which is that conversation, which is to challenge the board in that scenario on demand assumptions. Did you ever have that conversation, like in a high quality construct? Because I think one of the challenges that many of us have with engagement is that holy grail conversation is elusive. It can happen in hyper structured ways.
Yeah.
What tends to happen, at least for us, is its lowest common denominator, right? It's like, go get an SBTI aligned, but it isn't a high quality with, and also a lot of times we actually don't know. I would say we don't know that company well enough to make the call demand in their market and can't keep up. So anyway, did you ever have that call?
So as it happens in the case of Eni, because it is impossible for you guys to vote us out. I mean, you can only vote us out once every 3 years, right? We're not up for annual election, and we're up for election as a slate. So you can vote against all of us or none of us. So we were very insulated from that type of action. In other markets, I think it is immensely effective. So I think voting against directors, even if it's 5 or 10%, is such a slap in the face for directors. No director wants that. No director wants to have a significant vote against them. So the converse argument to that is, we need to have this discussion, guys, because investors are going to vote against us. If we don't demonstrate that we've had the discussion and that we've undertaken the stress test and that we can report transparently that in a 1.5 degree aligned world, our portfolio is resistant. You need to be able to say that. And I guarantee you most of the companies are not, based on, I can see what they're doing. And we in Eni would benchmark ourselves against all our peers, and we would think, they're not 1.5 degree aligned. So that's one. Divestment is an interesting one. Obviously, for example, we know that in the case of the Exxon vote, there had been so much divestment that the types of investors who would have supported the nomination of all 4 of those candidates, many of them had gone by then. So they only got 3 out of 4 over the line. So your impact is diminished if you have sold. On the other hand, companies live in fear of divestment. They really do. The number of times I have heard in my boardroom the CEO, the CFO, IR talk about how we are facing headwinds, how, our PE ratio is lower than, our electricity business. We're actually in the process of spinning out our electricity business, 10, 20, or 25%. We'll still have control, but just to boost our valuation, because the electricity business has a much, much higher rating. It's just much better appreciated by the market than the oil and gas business. So that stuff really weighs on boards, and that is caused by the fact that investors are losing faith in the industry. And sometimes it's motivated by an ESG sort of, I'm anti-oil and gas, and in other cases it's just a cold hard look at the fact that it's a risky business and the risk return ratio is turning against the industry.
So one point I just want to make about the 1.5 alignment, I think we have to acknowledge that the carbon budget feeding into that, there's some uncertainty around that. So I think the IEA used a 380 gigaton figure roughly, and there was room for negative emissions technology. The best available science now for a 50% probability of 1.5 is 250 gigatons. And we're going through like 50 gigatons roughly, like I'm trying to keep the numbers really round here, but we're really burning through that fast. Yeah. So I think I'm going to park that. Like, how does a company like any revise that? How do you revise that down? But I want to leave time for Q&A. I just want to cycle through a couple of the other tools that we have. So we've said I don't know if we've actually talked much about non-binding shareholder resolutions, but I think my assessment is that we're starting to reach the endpoints of the effectiveness of that tool, where it's non-binding. We've gotten majority non-binding votes in Australia at Woodside, and they've been ignored by the company, literally majority votes. Then we've got voting against directors. There's voting on remuneration is another one. Nominating directors. So we've seen that at engine number one. We had some commentary this morning about how ultimately, like my view is that there was a huge tactical success and actual strategic failure. Is probably the best way to describe it, because that company's positioning has not changed. And I think there's a number of reasons for it that we don't need to labor right now. But we do have another example in Australia where 4 directors were nominated by a large shareholder, Grok Ventures, which is owned by Mike Cannon-Brookes last year. And those 4 directors are now in the boardroom. And there's actually 5 who are on there through that kind of process. So there's a majority of that board who want to see far more aggressive decarbonisation and are pushing for it. Do you think that's where it's going to go? NBIM, LGIM, nominating directors?
So I haven't thought super deeply about this. In some ways, we're in reaction mode. So we'd have no plans to propose directors. It's just not our skill set right now. Do I, from with that LGIM hat on, is a world where this tool is used more good for the US capital markets, let's say with the universal proxy? Probably. So I think it's probably having more diverse directors proposed more often is going to keep things fresh. So I don't know how we would play structurally to support that. We will just evaluate each director and try to pick the best ones. But we aren't prepared from a research perspective to get in that game at this point.
Eivind, do you want to comment on that one?
Not too much, really.
No worries.
But we don't nominate directors today. We're in some nominating committees in Sweden, but that's it.
Okay.
Can I jump in on this one?
Yeah.
Because it's true that the process of identifying qualified directors is immensely demanding, and it's unrealistic to expect investors to be able to do it, especially on large portfolios. The way it works in Italy is that because it is so routinized, and 1/3 of directors come up for a vote every year, the Institutional Investor Association nominates a headhunter for a 3-year period, and that headhunter goes through the process of recruiting, evaluating, nominating, et cetera, in exactly the same professional way that a nominations committee would do. It's just that it is separate and apart from what the controlling shareholders do. And I should clarify that 90% of listed companies in Italy are controlled. There's a controlling shareholder, government, family, Versace, et cetera, or a holding company like Mediobanca or Generali, et cetera. So when you have that kind of ownership structure, if you don't have minority nominations, you have a completely insider board. So that was the reason for setting it up in that way. But my point is that the process for selection is very professionalized. If you don't have that, it's very, very difficult to pull off. So I understand that none of you would have the wherewithal to play that kind of role. But if it is collectivized, if somebody else is coming to you and saying, you know, Russell Reynolds is our headhunter this year, and they recommend, you're, you know, a major shareholder in company X, and they recommend this individual. Would you back it? In Italy, the investors all back it. They basically, they outsource, right? Very occasionally they'll say, I actually have someone I want to propose. I was one of those, actually. I wasn't introduced by a headhunter. The headhunter vetted me after. It was actually one of the pension funds that picked me, and then tested the idea with, you know, 5 or 6 of the big institutions, and then it went to Russell Reynolds. So that's how it has to work, because it would be unrealistic any other way.
Thank you. Certainly some good strategy ideas there, Karina. Going to wrap up or throw to questions in a moment. As you think of your questions, there is going to be a roving mic, so think of your questions now. I just wanted to add one more tool into the mix, which is legal strategies. So shareholders, of course, have rights, and they can litigate to see those rights enforced and protected. There's an example of a case run by Client Earth in relation to a Polish utilities company that successfully saw a new coal-fired power plant not proceed. ACCR is a litigant in kind of world-first greenwashing litigation against Santos, one of the other big Australian oil and gas companies. So there are those rights available. I think it's probably maybe that's where things are going, but I think we've identified so far some emergent strategies, perhaps, for institutional investors in engaging effectively with listed companies. Do we have any questions from the audience? We have 8 minutes.
Hi, I have a question for John. So you talked about preserving your very diverse portfolio over the ultra long term using the kind of system stewardship approach. And I wondered, kind of a two-parter, but I wondered what if that approach results in short-term underperformance? How do you feel? Do you feel comfortable, and how do you speak to clients about that? Being the kind of second part of that question.
Okay, so I have a luxury, which is I speak with the stewardship hat on, which is across all of our portfolios and all of our clients. So I don't underperform by engaging one particular company on a strategy. I'm not the PM responsible to look the client in the eye and say, you know, we underweight or something like that. So it's, and that's how LGIM's organized, which I think is important when you talk to different, if you're putting pressure on your asset managers and just trying to understand how things are structured. How we're structured is the stewardship team is separate from the investments team. We report directly to the CEO, and there is tension, right? There are positions we are taking that our own PMs may or may not agree with because they have a different horizon. So it's a kind of a mixed answer to your question.
Can we take 2 questions this time, and then we'll take another round of 2?
Sorry, does this work? Okay. So having covered Wall Street for a fair amount of time, what has been kind of cool about AGL, and to a lesser extent, engine number 1, was that these were hostiles, corporate raider attempts. And my sense is, are you guys just being way too polite about this? And really, isn't that corporate raider, strategy, frankly, going to be more effective? Because it certainly was in Australia.
Hi, this question is for John. I would like to know for your US-based portfolios, when it comes down specifically to ERISA portfolios, how do you get around the higher, let's say, higher threshold that it has in order to, not only vote against directors, but also engagements, specifically when it comes down to talking to companies about climate change, talking about social issues, because these are not necessarily supported by this, but it's a specific standard. So I would love your input on this.
Yeah, I'll reserve the right to be polite, no matter what tools we employ. But yeah, so I think we will have to consider all options, right? But we're a long-term investor in these companies. The management is there to represent us. We vote them in every year. If a different slate comes to our vote, we have to take, consider that. But for now, we're not considering any more active options.
If I can comment on that as well, like I agree with you. Like I think that we are going to see effective hedge fund style campaigns spring up. I hope we do. If there's any hedge fund people in the room who would like to collaborate on them, come and say hello. But I certainly would maybe not see it as the role of the Norwegian state to go hostile just yet. Maybe that I think that it depends on the mandate is my view. But I think that if funds are being set up or moving towards those mandates, I think they have the potential to be super effective. Anyway, that's moderator privilege. I'll throw over to you, John.
Sure, and I'll briefly answer that and then the ERISA question. So on the hostile one, we know as a large asset manager, our most influence frankly comes from the media, right? So when we file a shareholder resolution, I'm convinced that the most influence is the coverage of the resolution rather than the resolution itself landing in the hands of the director. So you use that very carefully, right? So you have a brand, you have a position, and so you think very carefully about what is, as you mentioned, what's right for the Norwegian government. It's like, what is right for LGIMA? What fits responsible investment? So you use that carefully. So if you're a small new asset manager, you want to break onto the scene, of course you're going to do something splashy. So to the ERISA question, and I do spend a ton of time with our ERISA lawyers, is as long as your stewardship strategy or your proxy voting policy is in the best long-term interest of your beneficiaries, you will always get them to nod their head. Where the real rubber I see is, if you ever pursue something that you can't put it in writing, is in the best long-term financial interest of your clients, right? So that line of is the pursuit of, the next thematic issue that comes across my desk, harmful chemicals, or can I confidently say that's in the best long-term financial interest of this portfolio? If I can put down in writing, then I will always get my that's kind of the way I would respond to it. There are things that are, oftentimes the critic says, prove it, right? What's the proof? So, and I haven't gotten that same local challenge. We have talked about this, but I haven't gotten that same proof, and that's where you do fall back on the systems argument, right? Because I can point to why climate risk is going to impact, GDP growth, or, and so there is this interplay between, do you have to prove it at a security level? Can you prove it at a portfolio level? Like, how do you get comfortable? It hasn't been a huge stumbling block for us, because that's the pursuit is from that orientation.
I am going to not give you 2 more questions. I'm sorry, we only have 2 minutes, but what I am going to do is give each of our panelists 20 to 30 seconds for final thoughts. As you are thinking of what those final thoughts are, we're having an event on Thursday night where we will be discussing the topic of playing to win, what it's going to take to win the energy transition. For us, it looks like looking at shareholder strategies that will prevent new FIDs into major oil and gas projects. That really is what we're looking at. So if you would like to come and let me know, and we will send you an invite. We'd love to see you there. Thank you, Karina. Final thoughts?
Yes. Yes. We are in a situation where board directors have immense power, and that power is not commensurate with their knowledge, or rather their knowledge is not commensurate with that power when it comes to climate change. And that's simply because of the evolution in the way that board directors have progressed over their career. The people who are of an age today to serve on boards grew up at a time when, competence in this area was not a required skill to rise up the corporate ladder. So there is a real job to be done, and that's why I created the Climate Governance Initiative, but there's a real job to be done also by the people to whom the directors are answerable. So I would really urge you to set expectations of the decision makers in the room, your directors, and see to it that they know that you care, that they have this knowledge, and that if they don't have it, they're prepared to seek it. Nobody needs to be perfect, but they need to demonstrate a certain degree of humility in acknowledging that they don't necessarily know everything they need to know, and that they're going to listen to their shareholders and listen to other experts, listen to the scientific community, and pull together the skills that they need to do the things that we've just heard John and Eivind lay out. Because if they fail to do that, they are failing you. And unless you tell them that, why would they care?
Eivind.
There's a lot of talk these days about sort of different tools, and it's very important, but I think the fundament for all engagement has to be long-term trust-based dialogues where the board members know that you are somebody who's not out for headlines. You're out there for the benefit of the company in the long run. And the sort of trusted advice that you give to this company is in their best interest as well. So we spend a lot of time on that, and that we believe that is the most efficient. Now, sometimes we do have to turn up the volume a little bit, right? So sometimes we vote against some directors, we'll file our own shareholder proposals, but it is not the rule, it is the exception. So I just want to flag that as well. We still think that that is the most effective strategy. Doesn't get you the most headlines, but we think that has the highest impact over time.
Can I just say the quiet word from NBIM carries a huge amount of weight in the boardroom. So you don't need to court headlines as long as the board knows that you've raised a concern. So don't be shy.
And I can make it simple on our side is just demand evidence that the engagement is effective, from us, but from all of our peers, from whoever's managing your assets.
Great. Thank you so much. Will you join me in thanking the panel?